Today, we will be presenting Cash is King, Optimizing Your Working Capital Model. The presentation focuses on how businesses can unlock sustainable growth and resilience by managing their working capital strategically. In our group, I am Anushka Roy and I have my partner Muskan Sachdeva. Now, coming to the second slide, the imperative of cash flow, why cash truly reigns. In business, profit alone does not guarantee survival. Many companies report profits but collapse because they run out of liquidity. Working capital is the true measure of operating liquidity. It is defined as current assets minus current liabilities. The most powerful position is when companies achieve negative working capital, that is, customers fund operations upfront while suppliers are paid later. This creates a major advantage, that is, less capital is tied up, which means higher returns on invested capital. That's why we say cash is king. Working capital can be optimized by focusing on three key drivers. First up, customer payments. Encourage earlier collections through subscriptions, memberships, or incentives. Second in line, we have supplier payments, that is, extending payment terms without damaging relationships. And lastly, we have inventory. Reduce stock holdings using just-in-time methods and better forecasting. When managed well, these levers generate significant benefits. That is, they can free up cash to fund growth, reduce dependence on external financing, and allow flexibility to compete with thinner profit margins. The benefits of negative working capital are substantial. It allows growth funding. Businesses can use customer cash to finance expansion, reduce dependency, that is, less reliance on banks or equity investors, and margin flexibility, that is, ability to price competitively even with slim margins because profitability is less constrained by capital needs. In short, negative working capital isn't just an accounting position, it's a strategic advantage that powers resilience and long term success. Now, coming to the case study of Dow Jones, the publisher of the Wall Street Journal. Dow Jones leveraged subscriptions where customers paid upfront, giving it negative working capital. In 1992, working capital stood at minus 72 days, equal to about $360 million in free cash. By 2006, even after going digital with WSG Online, Factiva, and MarketWatch, working capital improved further to minus 77 days. This cushion allowed Dow Jones to invest in digital products without heavy reliance on external funding. Net income tripled from $107 million to $386 million, and the company was eventually acquired by News Corp for $5 billion.
Okay, so our second case is Costco, which disrupted retail using a membership model. The formula was simple: collecting membership fees upfront and keep inventory moving quickly. Receivables were kept at just 3 days. In 1996, working capital was minus 7 days. By 2006, it improved to minus 11 days, equating to about $3.6 million in free cash per store. Despite capping profit margins at 14% or less, Costco achieved $59 billion in sales with 48 million members by 2006. Membership fees alone generated nearly $1.2 billion in profit. Negative working capital fuels aggressive growth and customer loyalty even with razor thin margins. So, what do these cases tell us? Both Dow Jones and Costco prove that customer cash is a superior funding source compared to investors or banks. Achieving negative working capital should be seen as the holy grail because it unlocks financial independence, provides operational flexibility, and turns customers into a de facto funding score. This is a shift from just managing cash to using cash strategically. Now let's take a look at Apple, a company that has mastered working capital efficiency. Apple collects customer payments upfront from iPhones, services, and App Store purchases while negotiating suppliers' terms to 60 to 90 days. Combined with their world class supply chain, this creates a consistently negative cash conversion cycle. In some years, Apple's cash conversion cycle has been as low as minus 72 days, meaning they are holding customer cash for over 2 months before paying suppliers. Even in financial year 2024, it stayed around minus 33 days, which is remarkable at their size and scale. This approach lets Apple invest heavily in R&D and expand its global retail presence and return cash to shareholders, all without relying much on debt. The key lesson is that a well designed working capital model isn't just efficient, it's a major engine for innovation and long term growth. To move towards negative working capital, businesses must ask these three critical questions. Can customer pay earlier through subscriptions, memberships, or discount for upfront payment? Second, can suppliers be paid later by negotiating terms while maintaining relationships? And lastly, can inventory be reduced by adopting just in time systems and optimizing logistics? These questions help businesses design smarter working capital model tailored to their industry. In conclusion, mastering working capital management is not just an accounting exercise, it is a strategic imperative. Cash is the oxygen of business. Without it, even the best ideas cannot breathe. By leveraging customer funded models, optimizing supplier terms, and reducing inventory, companies can build a strong foundation for sustainable growth. Both Dow Jones and Costco show us that cash is king and negative working capital is the true competitive advantage. Thank you.